Hello everyone, thank you for joining us for the final Tax Insights Live session of 2025. So today we're going to be talking about EIS and in particular common pitfalls and how to avoid them. So what are we actually going to cover today? Firstly, we're going to talk about what EIS is. We'll go through the details and as we go through we will talk about some of the pitfalls that can arise during the process. We'll then talk about SEIS, Seed EIS, which is very similar to EIS, but covers early stage startups. And then we're going to go into the detail of some very common pitfalls and how we might avoid them. So firstly, what is the Enterprise Investment Scheme, the EIS? It is a government offered relief which provides tax reliefs for individuals who invest in qualifying companies. And we're going to talk about what a qualifying company is shortly. So the reliefs are income tax relief is available to the investor of up to 30% of the amount they have invested, up to a maximum of £1 million per year or £2 million if invested in a knowledge intensive company. And again, we'll talk about what that is shortly. It's important to note this can't create a loss. It can only take tax liability down to zero. If those EIS shares are held for 3 years and they're not disposed of and the company doesn't disqualify itself, then when they're sold, there won't be any capital gains tax to pay. So those are the two main reliefs that we talk about when we talk about EIS. But also some slightly lesser known reliefs are that capital gains tax deferral relief allows investors disposing of any asset to defer a gain arising from the sale of that asset into EIS shares. Losses on EIS shares may be offset against taxable income, and EIS investments should qualify for business property relief after 2 years of ownership. So those are the reliefs available under the EIS. As I say, the first two are the ones that are always talked about when we discuss EIS, but the others need to be not to be forgotten as well. So in terms of the process, how does it work? So we'll run through briefly the process from beginning to end. So the first step is usually that an advance assurance is obtained. We work with lots of companies to help them get their advance assurance from HMRC. And this is where we send a lot of information about the company to HMRC. And then if they're happy, they write back and say that they are comfortable that the company should qualify to issue shares under the EIS scheme. It's important to note that they're not signing off on any particular investment or any particular investor. They're just saying that based on the information they've received, they think the company should qualify to issue shares under the EIS. It's not compulsory to get advance assurance, but most companies do because most investors would want to see that advance assurance before they put their money in, so they can be as comfortable as they possibly can be that their investment will qualify. So then once the advance assurance is obtained, the money is received and the shares are issued. And then after that, a compliance statement has to be submitted. It's called an EIS-1 form. And this is where, again, we can help companies with this. The company will write to HMRC, give the details of the investors, the dates they invested, the amounts they've invested, the number of shares and so on. And then again, if everything's acceptable to HMRC, they will send the company a form EIS-2, and they will also send the company a form EIS-3 for each investor. And that has to be completed and given to the investor. And then that EIS-3 form is what they will submit with their self-assessment tax return in order to actually claim the relief. That's the process very, very quickly from beginning to end. In terms of advance assurance, we'll go back to the slide for a moment. In terms of advance assurance, this is an online process. It's a digital claims process, and HMRC say that they will stand by an advance assurance if the information that they are given is correct. So it's important to make sure that all the information submitted is full and accurate. The company will have to demonstrate certain things, as well as the numerical criteria around the size of the company and the percentage that the investor is going to hold and so on and so forth. The company will have to show that the money being raised is going to be used for the genuine growth of the company. So it will have to show through its descriptions and through any forecasts it's sending that there is actually a funding gap, that the money is needed for the genuine growth of the company. And the other criteria that will need to be met and that we need to demonstrate is called the risk to capital condition. So this says that HMRC wants to see that there is a risk that the investor may not get their money back, essentially. And the reason for that is that these very good tax advantages are designed to encourage investors to invest in genuinely risky early stage companies. And we all know the statistics, don't we, of how many early stage companies don't make it. So HMRC are trying to encourage individuals to invest in those companies. But if essentially there is no real risk, then HMRC won't be happy that EIS is available. So there's the two sort of subjective criteria, which are the growth condition and the risk to capital condition. So we need to talk about those in the advance assurance applications. Very important part of it. So often people say to us, well, we don't want our client, or we don't want our company to have to keep taking money and issuing shares, Can we get the money in? And then can we issue shares in tranches, say every quarter or something like that? So that's why they might use an advanced subscription agreement. So this does enable investors to invest in a company before the shares are issued. The advanced subscription agreement should be submitted with the advance assurance that we've just talked about to make sure HMRC are happy with it. And they will only be happy with it if it meets certain criteria. And those are that it does not permit subscription payment to be refunded under any circumstances. So it has to be that this is a subscription for shares. The shares may not be issued straight away, but it has to be subscription for shares. If there's a chance it might be refunded, then it's essentially a loan, and that doesn't qualify for EIS. So HMRC will want to be sure that it is a genuine investment for shares. They will want to be happy that the arrangements can't be varied, cancelled or assigned. There can't be an interest charge because, again, that's akin to a loan, isn't it? And a loan converted to equity does not qualify for EIS. And they will also want to see that in the advanced subscription agreement, there is a date for the share issue, which is no more than 6 months from the date of the agreement. So you can't get money in and issue the shares years later. Like I say, this is really an administrative tool to mean that companies don't have to be constantly going through the share issue process. They can batch them and do them in tranches, but they do have to have that reasonable time frame included. So as I say, if an advanced subscription agreement is going to be used, it does need to be included with the advance assurance. And we see this is a common pitfall, that people will get the advance assurance and then they'll decide that they want to have an advanced subscription agreement. And you really do need to do it the other way around, so that HMRC have seen the ASA in advance. So in terms of conditions that must be met by the investor, because obvious pitfalls are that somebody comes along and wants to invest in the company, but they don't actually qualify. So firstly, they can't be connected with the company. And this means they can't be employed by the company. They can't be purchasing the shares as part of an arrangement where somebody else will then subscribe for shares in a connected company. They can't control the company. And they can't have more than 30% of the assets in a winding up, or be entitled to 30% of the votes, or 30% of the 30% of the shares, the voting rights, or assets in a winding up, essentially. But it's really important. People often don't know that individuals, associates, that if people are associated, their rights are aggregated when looking at that 30% rule. People are associated if they are business partners. Certain trust arrangements, I won't go into that detail now, but essentially business partners or relatives. So spouses, civil partners, parents and grandparents, and children and grandchildren are all aggregated for the purposes of this 30% rule. And this comes up very often because people will often say, I'm doing a friends and family round and my father wants to invest. But if they own 100% of the shares in the company, the father can invest, but the father won't be eligible for EIS relief, because when aggregated with the son or daughter who owns the company, they in aggregate own more than the 30%. The individual can't receive a loan which would not have been made on the same terms if the EIS investment wasn't made. They can't be a shareholder already unless their shares were subscriber shares or risk finance shares, essentially EIS shares the first time round. They must subscribe for shares in a qualifying company. There has to be a genuine commercial reason for it, not just tax avoidance, and they have to hold the shares for the minimum 3-year period. And talk to people about this quite frequently when they come to us as the investor and say, if you've signed a shareholders agreement that says that if this company's sold, you have to sell your shares, and then that happens after 2 years, you also have to sell those shares, and therefore your EIS relief is likely to be clawed back. Because the really important thing for people to know if they're investing in EIS is that their relief can be clawed back through no fault of their own. If the company does something, if it is sold and becomes a subsidiary of another company, or if it changes its trade, or for some other reason it ceases to qualify, individuals can lose their EIS relief because of an action that they haven't chosen to take themselves. So really important for people to understand that potential pitfall. Next, we'll talk about the company. What conditions does the company have to meet in order to be eligible to issue shares under EIS? So as we said earlier, it has to meet that risk to capital condition. It has to have objectives to grow and develop its trade in the long term. And this is because, we said, HMRC want these tax reliefs to be available to people who are investing in genuine risky companies that are trading with a view to growth, not just to put money in, wait for 3 years, and then have had tax relief on the way in, and then have a tax-free exit. There has to be a UK permanent establishment of the company. The company has to be in good financial health. It can't be in financial difficulty at the time the shares are issued. It has to carry on qualifying activities, and there is a list in HMRC's guidance of non-qualifying activities. Most of them are around asset-backed businesses, so land, farming, hotels, nursing homes, and so on, but also financial and legal activities are also excluded. Maximum permitted age requirement. So the company can't be more than 7 years old at the time of the first investment, unless it is a knowledge-intensive company. And as I said, we're going to come on to what that is. It has to be an unquoted company not under the control of another company. This is really important. People often fall into this trap because people tend to set up a group structure and they might have different subsidiaries doing different things. And then they might want to attract investors into just one of the subsidiaries. Sometimes they'll say, this individual's got some skills they can give us in our, drinks business, say, and they want to invest in the drinks business and get EIS, but they're not going to be involved in the food business, the restaurant business, whatever it is, the other subsidiary. If the investor has shares in a subsidiary company, they will not be eligible for EIS because an EIS company can't be controlled by another company. So the presence of that holding company is problematic. So EIS always has to be in the top company if there is a group structure. Gross assets mustn't exceed £15 million before and £16 million after the investment. Employees mustn't exceed 250 or 500 for knowledge-intensive companies. And all subsidiaries must be qualifying subsidiaries. So they must be controlled to the extent of at least 50%. And property management subsidiaries must be at least 90% owned. So you can see there immediately that companies could fail to qualify on a technicality and not realise that they do. I would say that the most frequent ones are non-qualifying trades, people not realising that the trade falls into a non-qualifying trade, and actually financial health as well, because often people are getting money in to try to save the company essentially. But if it's in financial difficulty at the time the shares are issued, then EIS won't be available. And there is a technical definition of financial difficulty, so we get in touch if that's of interest to you or your clients. So all of the conditions must be met throughout the minimum holding period. There are some exceptions to that. The company can grow essentially. So things like the gross assets test, the employees test can cease to be met as the company grows. But most of them do need to continue to be met throughout the 3-year period. If you'd like the detail of which ones are snapshots and which ones have to continue to be met for the 3-year period, then please do get in touch. The shares can't be issued with any pre-arranged exit planned. So sometimes what we'll see when we look at an investor deck is that the company has tried to make the investment look fantastic to investors. By saying that after 3 years or 5 years, whatever it is, there's some sort of guaranteed exit mechanism. You can't have a pre-planned exit in that way. So that would disqualify the investment from EIS. And money from the investment must be used for purposes of the company's qualifying trade, for preparing to carry on a qualifying trade, or for research and development intended to lead to a qualifying trade. So you have to be able to say exactly what the money is going to be used for. So we talked a few times now about knowledge intensive companies. So there are a number of relaxations to the rules when a company is knowledge intensive. So these are, broadly speaking, a company whose main focus is R&D activity. So this is because there is a greater failure rate attached to these innovative companies who are trying to do new and risky things. They tend to need to raise more money in order to do the R&D before they become or their product becomes commercially viable. So this is a way of enabling them to attract that greater amount of investment within the EIS scheme. So the relaxations are that the investor limit is increased to £2 million from £1 million. That initial 7-year period that we talked about for the first EIS investment to come in is extended to 10 years. The lifetime maximum amount that the companies can raise from these risk finance schemes is £20 million instead of £12 million. And then the 12-month maximum limit is £10 million instead of £5 million. And finally, there's a greater permitted limit of full-time equivalent employees. It's 500 instead of 250. So you can see there are some quite significant enhancements to the scheme if the company qualifies as a knowledge-intensive company. There is an additional part of the advance assurance to be completed if it's a knowledge-intensive company. There's a bit more work to be done there because we do get HMRC to confirm in advance that they're happy that it is a knowledge-intensive company, or a KIC, as we sometimes call it. So you can see here in terms of pitfalls, assuming that you're a KIC is a risky thing to do, because if you rely on these enhanced reliefs and then it transpires HMRC don't consider that you are a KIC, then you will have you'll have disappointed investors. It's very serious consequences. So important to make sure that when the advance assurance is obtained, the additional information is given to HMRC so they can confirm they're happy that it is a knowledge-intensive company. We're going to look very briefly at the seed EIS because a lot of the rules are the same. There are some slight differences in the rules, but broadly speaking, the rules and certainly the principles are the same for EIS and SEIS. So there were some changes back in 2023, obviously quite a while ago now, but just for completeness, we are including those amounts in here. The Seed Enterprise Investment Scheme allows income tax of 50% of the amount invested, up to an annual subscription limit of £200,000, which used to be £100,000. As with EIS, gains on disposals of SEIS shares after 3 years may be exempt from capital gains tax. There is a capital gains tax exemption, which allows investors disposing of any asset and incurring a gain an exemption of up to 50% of their subscription in SEIS shares in the same tax year, so that reinvestment relief essentially. Losses on disposals of SEIS are allowable for capital gains tax purposes, and SEIS investments should qualify for business property relief for inheritance tax after 2 years of ownership. So again, conditions are very similar between EIS and SEIS, no prearranged exits, all these types of things we talked about, and some of the pitfalls that we're going to come onto in a moment are common to both. Essentially, the company has to be a lot smaller for SEIS. So this is for startup companies. So the new qualifying trade has to be less than 3 years old. The company can't have gross assets of more than £350,000, and it must have fewer than 25 employees. So it has to be a lot smaller than the EIS companies that we talked about already. Very commonly, a company will want to apply for advance assurance for SEIS and EIS at the same time. So it will say it wants to raise £1 million, it will raise the first £250,000 through SEIS, and then the remaining 750 through the main EIS scheme, and we can do the advance assurance at the same time. A company can't have received EIS investment and then get SEIS investment. This has to be done first. The list of qualifying trades is the same. The rules around not being in financial difficulty are the same. Lots and lots of very similar rules, but you can see that this is for the smaller, earlier stage companies, which HMRC consider inherently more risky, hence the 50% income tax relief rather than 30% under the main EIS scheme. Just a word on recent Budget 2025 changes. And if you would like a copy of the Allegro Tax Budget 2025 summary, please do either email me. I'm going to put my email address up at the end of these slides, or on my LinkedIn. I have it saved as a favourite, so you can just download it from there. So if you'd like that, do let me know. But in terms of EIS, the gross asset limit has been increased to £30 million before the share issue and £35 million after. The annual investment limit is increasing from £5 to £10 million. Knowledge intensive company annual investment limits are increasing from £10 to £20 million. And the company lifetime limit is increasing to £24 million or £40 million for knowledge intensive companies. And those changes from 6th of April 2026. So I've run through already the rules that apply at the moment, but these changes are coming in. That was announced on the 26th of November, so very recent news. So we've talked about some pitfalls as we've been going along. So I just thought I'd draw attention to some of the really key ones that we haven't necessarily mentioned in detail. So firstly, the order of investment and the timing of the share issues. So as we did say, SEIS has to come first. So if any shares have been issued and an EIS compliance statement has been submitted, SEIS will not be available. So it's really important that the SEIS shares are issued first. There was a case where somebody had submitted the wrong form. They meant to submit an SEIS compliance statement. They accidentally submitted an EIS compliance statement. Then they went to HMRC and said, "I'm sorry, this is an error. Can we remove that and put the SEIS statement in its place?" HMRC said no. You've missed out on your SEIS. So it's really, really important to do it in the right order. Other points around order of investment. Both SEIS and EIS shares must be fully paid up on issue. So you can't have the sort of banking problem, or someone's away and they're going to put the money in when they get back. The money has to be paid in before the shares are issued, because one of the requirements is they must be fully paid up on issue. So our recommendation is get your SEIS funding in, and then issue your SEIS shares, and then get your EIS funding in, and then issue your EIS shares in that order. It can be a problem if you get all the funding in at once, because the gross assets limit of £350,000 for SEIS is likely to be breached at the time those SEIS shares are issued. So really important to do it in that order: SEIS funding, SEIS share issue, then EIS funding, EIS share issue in that order. Conversely, it's also important not to get the money in too far in advance, because if HMRC deem it to be a loan that's been converted to shares, that won't qualify either, because they have to be paid for in cash. It can't be a loan that's converted. So it's important to keep that timing tight, but do it in the right order. Share buybacks. There's a particularly nasty rule that people often don't know about that says that if there has been a company repurchase of shares from any shareholder, not just the EIS or SEIS shareholders, any shareholder, in the period 1 year before to 3 years after the EIS share issue, then that can cause the EIS tax relief to be withdrawn. So again, this is another way in which an EIS shareholder can lose their relief through no fault of their own. So lots of advisors don't know this. So it's always rings alarm bells if there's been a company purchase of own shares, because it is very likely, unless it's done at very, very nominal value, it is likely to have an impact on the EIS relief and cause that to be either not available in the first place or withdrawn partly or fully. So really important to be aware of that one. No pre-arranged exits. We talked about this as we've been going along. A pre-arranged exit is defined as one where arrangements exist with a view to the repurchase, exchange or disposal of the shares or other shares of securities of the issuing company. And there are other criteria as well, but I wanted to draw that one out particularly because arrangements is taken to apply to all shares issued on the same day. So this is a problem with put options. So if there are put options, even if they are not over EIS shares, if they are over shares issued on the same day, that will be problematic for the EIS share issue. So it's important to don't issue shares on the same day as EIS shares if there are put options involved. I mean, really, if you've got any kind of exit arrangements over any of your shares, you definitely need to get advice because, as we've seen so many times already in this session, you know, arrangements not affecting the EIS shareholder personally can still cause them to have their relief withdrawn. So please do get in touch on that one. Preferential rights. So EIS shares and the SEIS shares cannot carry certain types of preferential rights to dividends and rights to assets in a winding up. And this refers to the order of the distributions rather than the amounts. So the solution to this one is that all classes of shares, EIS and non-EIS, must all participate at different at each level of a waterfall. So if you've got a waterfall which kicks in if there is a winding up of the company, you need to make sure that somebody gets everything, somebody gets something at every stage. So you often find there are arrangements where one class of shareholders will get 99.99% of their investment back, and then the other shareholders will get 0.01% of their investment back. And then when the first class have been repaid, then it switches around and the second class are repaid. And HMRC have signed off on that. It's a known sort of way of doing it that is usually acceptable to them because they their view is that as long as each class participates at each level of the waterfall on the return of funds, then that is acceptable. But this would all be laid out in the Articles of Association, which must be submitted with the advance assurance application that we talked about right at the beginning. And if the articles are to be changed, then again, you know, another advance assurance must be sought to make sure HMRC are happy that the company's articles don't preclude EIS from being available. So I hope that's been helpful in terms of our looking at pitfalls. Like I say, we talked about quite a few as we've been going along. I always say to people that the concept of SEIS and EIS is very, very straightforward, but the legislation is full of pitfalls and bear traps. I mean, we've discussed as we've been going along the lists of criteria, the lists of exclusions and so on, so you can see how people quite easily fall foul of those. And then I've drawn out here those 5 very specific pitfalls that tend to come up time and time again. But with EIS and SEIS, I mean, I can't emphasize enough, it is a complex area, although the concept of the relief is simple. The detail is not straightforward. So expert advice should always be sought when you or your client is looking to use SEIS or EIS. So I am happy to take any questions if you would like to put them in the chat. Thank you for listening to this session, and thank you for your support for our Tax Insights Live sessions in 2025. We do appreciate it. See you in 2026. We haven't yet scheduled our sessions for next year, so if there are particular topics that you would like us to cover, please do let us know. It's always really good to feel that we are answering questions that are coming up for people in their sort of day-to-day professional lives, so please do be in touch. My email address is sarah.gardner@allegro-tax.com. I'm also on LinkedIn, quite easy to find on there, I think, and on there all the time. So we haven't had any questions in the chat, so I will leave it there, but thank you again. Wish you all a very Merry Christmas and a Happy New Year, and we will see you in 2026.